Welcome to a special presentation sponsored by Corum Group. Covering the latest activity in tech M&A across 29 market segments. Corum is the global leader in tech M&A, founded by CEOs for CEOs. With over 36 years of proven success, over 400 transactions, and over $10 billion in wealth created, Corum is the leading educator and sell-side advisor of software, IT, and related technology companies. Corum's global research is the largest dedicated operation of its kind, generating reports on the latest disruptive tech trends across the most active market segments: horizontal, vertical, consumer, infrastructure, internet, and IT services. Corum sponsors or hosts over 200 events per year in over 100 cities and 50 countries. That's an event every 36 hours. The Merge Briefing is a 90-minute industry update and overview of the M&A process to get you caught up quick. Selling Up, Selling Out is the definitive executive M&A half-day bootcamp, going over how to prepare, position, value, structure, negotiate, and survive due diligence for an optimal outcome. It's the most attended tech executive conference in history. The co-sponsors, contributors, and attendees of these events include leading names in the technology and finance ecosystems. Go to the Corum website for a short video series covering the Corum process and how it can get you the valuation you deserve. You'll learn how to get the attention of tech buyers from around the globe, how to generate maximum value, and how to avoid mistakes that could kill deals in a complex merger environment. It's time. Let's begin our webcast.
Today's tech M&A environment has changed. The buyers are sharpening their pencils, looking closer at your model. Let's look at 10 ways to conserve, even increase the value of your company now.
1. Exit plan. We've worked with lots of serial entrepreneurs on the sale of multiple companies. They differ from first-time company founders in one key way. They nearly always have an exit plan. In other words, they begin with the end in mind. From the moment they start the company, they not only have a vision of the products and technologies, but also the business model, management team, revenue and support structure the company needs to get the highest value in an M&A event from either a strategic or financial partner. Of course, those same attributes may lead to an IPO as well, but over 95% of all exits are through merger. The difference is they make this an integral part of their plan and strategy from day one, and this brings significant value when they decide it's time to exit. Beginning with the end in mind can be one of the most important steps an entrepreneurial founder takes to increase value.
2. Increase recurring revenue. By now, hopefully you realize that one of the best ways to boost value is to increase your recurring revenue. But frequently, technology companies approach this as a technology problem, working to move from an on-prem version of their software to a modern, cloud-hosted, multi-tenant SaaS solution. While that's an ideal goal, it's not necessarily appropriate in all circumstances, and it's definitely not fast. In reality, though recurring revenue is a business problem, what buyers really want is your revenue to be stable and predictable, regardless of the delivery model. Long-term contracts, paid regularly, provide recurring revenue even if technically being paid out as support, maintenance, licensing, or even managed services. What buyers don't want is a company paying you a wad of cash up front and then disappearing, living and benefiting off of your software for the next decade without ever paying another dime. Or lumpy, unpredictable revenue driven by major one-time projects that will never be repeated. Making annual support a required component of any new or renewing contract is one way to approach this, creating the kind of predictable revenue stream today's buyers expect. Different markets will dictate different approaches, but predictable, consistent revenue is at the heart of what buyers want to see across the board.
3. Your management team. A well-rounded, experienced, and cohesive management team increases the value of your company. Buyers don't want to have to fill in gaps in today's tough employment market. When starting and building your company, always be thinking about what buyers and investors will be looking for in experience, credentials, ability to work well together, and how your team complements each other in terms of skills and disciplines. Buyers can sense the way your team works together almost immediately. If you are selling your company as part of a succession plan and looking to retire yourself, figure out who the logical next in line is at your company already. Some buyers will prefer to bring in their own CEO, but most would prefer to work with someone who already understands the product, customer, and market. You may even want to put this person in front of buyers as part of the management presentations once you get into the M&A process. Regardless, during that process, be sure to highlight the experience of each executive on your team, their achievements, and relate these back to real-world examples of their contributions to the company. Also, focus on how well the team works together to get things done. Give examples of the team being able to solve problems and achieve targets together. A great management team gives buyers confidence in the future of your company and therefore increases its value.
4. Customer churn. Customer churn is the percentage of customers that do not continue buying the solution in the following year. This is especially important for companies with SaaS businesses and is a principal factor in valuation. All of the buyers, strategic and financial, look at churn, both net and gross. While the financials, team, IP, markets, and customers also need to fit with a buyer strategy, churn primarily indicates how good and scalable the product is. As a SaaS company becomes larger, the size of the subscription base becomes large enough that any kind of churn against that base becomes a big number. That loss of revenue requires more and more bookings from new customers just to replace the churn. As a result, growth slows. It depends on business to business, but the real churn of a SaaS acquisition target needs to be lower than 5 to 10% to be considered attractive, and consequently command a premium in valuation.
5. Discipline, process, and models. Another way to increase your value is through discipline and process. Are your models tight and easy to understand, not reliant on individuals? You don't want the practices to be only based on the last person you hired for the job. It should be well thought out, based on trial and error. For example, how do you identify prospects? How are leads converted to sales, installations, and ongoing support? How do you change support policies? Pricing. Did you use the challenges and opportunities created by COVID to improve your processes and models? Are you able to take advantage of the flexibility created by the new virtual world, leveraging remote or offshore talent? Have you been able to apply discipline to your development roadmap? Often, new features are driven entirely by current customer complaints rather than unlocking new revenue opportunities. Satisfying current customers is absolutely critical, but as a growth business, a roadmap has to include innovation for customers you hope to win to underpin that growth in the future.
6. Customer concentration. For many companies, customer concentration is a value depressant. Too many eggs in one basket is a significant risk that can seriously limit a buyer's interest and may even kill an M&A deal. Let's say 20% or more of your business comes from the same long-term loyal customer. Is that a safe source of revenue? Maybe. But what if they switch IT strategies, file for bankruptcy, or are acquired by someone who uses a competitor's products? You could be hit very hard by the loss of that income, and it takes a lot of time to make it up. Keep your best customers happy, but diversifying your base will make the buyers happy as well.
7. Improve cash flow. Especially in today's environment, buyers want profits and don't want to spend a bunch of money in addition to the purchase price, all in the hopes that you can get to break even in the next few years. While some buyers are open to acquisitions with negative EBITDA, most will still insist on a path to profitability. Thus, a key driver of value is the free cash flow that your business can create, tightly related to the rate at which customers are acquired. Highly profitable customers generate strong cash flows. More and more entrepreneurs are embracing lean manufacturing concepts to achieve these goals, maximizing customer value for your offerings and minimizing waste when delivering to the customer. What costs are we incurring that don't support an efficient, customer-focused organization? Ask your management team, how do our customers define the value they receive for the products and services we deliver? Are there elements to our offerings that are nice to have? Are there any costs we can eliminate or reduce? How can we make delivery of our product more efficient? Focusing on these concepts can be an important way to maximize the value of your company.
8. It's important to build partnerships and alliances. Many growing companies forget to play well with others because they're so focused on building product, growing the platform, and winning sales. Certainly, these are critical, but don't overlook the benefits of building an ecosystem of business alliances, companies invested in your success. The old adage, "we are judged by the company we keep," holds true. Sure, alliances take time to build and need effort to keep healthy, but that's exactly why they create validation. A partner ecosystem expands your thought leadership, your value proposition, and improves stickiness. It will generate leads, extend your sales team, strengthen your competitiveness, and make you an easier, safer decision for the customer. This is the result of what we call weaving your business into the fabric of the industry.
9. Year-over-year growth. The buyers are buying into your story, what you represent to them in the future. Thus, year-over-year growth is a primary driver for how companies are valued in today's M&A. Again, buyers are getting back to basics on financial metrics. Growth factor gives buyers a solid sense of how well your company is run, how well the markets are receiving your products, and how efficiently your sales and marketing organizations are operating. For companies with SaaS offerings, most buyers will determine the purchase price using revenue multiples based strictly on year-over-year growth rates, irrespective of EBITDA. In other words, if you're investing your earnings into expanding geographically, increasing market share, and beating out the competition, then for buyers, your year-over-year revenue growth is clearly reflective of future performance, and after all, the future is what they're buying.
10. Timing. Timing is a critical factor for knowing when to sell your company. Sometimes timing is driven by macroeconomic trends, recession, bull market, or sometimes by changes within your own sector or industry. A lot of times, you don't know what the future may bring. When things are going well for your company, that's the best time to sell. The best advice is to pay attention to what's happening in your sector. If competitors are getting acquired, that can be good. Buyers are hungry. There's consolidation going on. But be careful about waiting too long. You don't want to be the last man standing with all of your competitors part of a much larger, more competitive global enterprise. There's normally not a lot of value for such companies.
While the public IPOs, SPACs, and VC deals have taken a hit, the market for private companies is very robust, as most of them are bolt-ons, or as some call them, add-ons or tuck-ins. In fact, over 90% of privately held companies are in this category, at least until each sector is consolidated. If you have any questions about your company or sector, Corum can provide confidential research and an appraisal of your opportunity in today's market for the sale of private tech companies.
Thank you for joining us for this special presentation. If you have questions, be sure to email us at info@corumgroup.com. Or if you have a topic you'd like to see covered, please let us know. This webcast will be available at Corum's website, corumgroup.com, after the rebroadcast in 1 week. Please join us for one of our live M&A educational events in your area. We strongly encourage you to attend. The better educated you are on the M&A process, the greater your chances for an optimal outcome. This is evident in our interviews of those who sold after attending one of our events, filmed while celebrating their transaction fishing as Corum's guest in the Gulf of Alaska. Find these and more at corumgroup.com. Thank you again for your participation. This concludes today's webcast.